Hope everyone's having a great week. Joining me today is macro analyst Luke Gromen. He's the founder and president of FFTT, which puts out amazing research reports. I haven't had him on the show in about a year, so I'm really looking forward to getting into all the latest economic data. It's great to see you, Luke. Thanks so much for returning to the show.
Absolutely, Natalie. Thanks for having me back on.
Well, I want to start sort of big picture before we zoom in. Rates are still high. Inflation is elevated. Stocks hit new all-time highs. So did Bitcoin. So what's your macroeconomic outlook and assessment?
I think my macroeconomic assessment is pretty straightforward, which is if the Fed hikes rates, I think inflation is going to keep bubbling higher. And I think if the Fed cuts rates, inflation is going to keep bubbling higher. The issue is the debt. And they screwed up by not letting inflation run high enough for long enough or higher for longer back in 2021 and into 2022, really. They should have let inflation run hotter. They didn't. I understand why they didn't. Politically, it was difficult, but by doing that, they've really put themselves behind the eight ball. Now we're really going to, I think, see higher for longer inflation. And it all really comes down to that fiscal dominance concept driven by the debt.
So what's happening right now with the Treasury market? Because one thing you talk about is that the shadow third mandate of the Fed is to make sure that there's no dysfunction in the Treasuries. Some of the auctions have been maybe abysmal has been a dramatic term, but basically prime brokers have to eat a lot of the Treasuries, right? And you brought up that ISDA letter in some of your recent tweets. I talked about that with Larry Lepard in my last episode. So what should we know about the Treasury market right now?
I think it's functioning fine. If you look at some of the volatility metrics, the move volatility index, the U.S. government liquidity, U.S. government securities liquidity index, they're fine. With that said, as you just mentioned, we've had the auctions. It seems like for every one good auction we get two or three or four kind of to really auctions, and the prime brokers have on a trend basis had to take a lot more down. Their holdings of Treasury securities as of a couple weeks ago were back to the highs. The ISDA letter that you referenced, I think, is a really interesting breadcrumb or signpost. The ISDA is a proxy for the too big to fail banks, and they are asking the Fed to go back to the regime that they had in April 2020 through May of 2021, when the Fed suspended or exempted U.S. Treasuries from the capital requirements, Basel capital requirements. So basically, banks could buy an infinite amount of treasuries. There's no capital requirement to treasuries. That's QE, just by another name, to be clear. That's just QE done through the banks instead of through the Fed. So the fact that ISDA is writing a letter to Fed, OCC, Officer of the Control of the Currency, and I believe the FDIC as well, asking for a permanent exemption of treasuries to the SLR, or supplementary leverage ratio, to the regulations, tells you that I think that they see that there is a problem coming, and they're trying to get out ahead of it. And so that's kind of where we are. Is it's the Treasury market is fine now, and it's sort of like one of these any given Sunday things. Any given auction could be not great. Primary dealers are holding a lot more of the paper, having to hold a lot more of the paper on a trend basis, and they're asking for relief already. So that's the state of affairs there.
Well, right. I mean, there is no obvious crisis right now. So what is it that they're seeing that is not obvious to even the financial media that's not talking about this? Like what's over the horizon?
I think they're looking at the supply. When you've got the government putting out a $7.3 trillion budget, when you look at the Congressional Budget Office outlook, I think they're looking at the net supply over the next 12 months. And in the short run, you can run down the reverse repo, which has been happening and probably will continue to happen. Then you've got the Treasury General account, which will which provides Yellen some flexibility and gets us through to the election, I think, assuming the dollar doesn't rally sharply in that time for any reason. But once you get beyond that, you're sort of you've got to have a weaker dollar. And if you don't get a weaker dollar, or if heaven forbid, economically we get some sort of binary slowdown, and that could be part of it too, is a lot of these big banks could be looking at sort of the marks on their commercial real estate book and going, look, we're all going to extend and pretend and it's all fine, and it could be fine for years to come, but it could also not be fine like tomorrow. Mm-hmm. And that's the nature of where we're in, because you're in a big market. They have a lot of assets collectively in commercial real estate as an industry. And the bid-ask spread on a lot of these properties are very, very wide. So when you have very wide bid-ask spreads, you don't get a linear resolution. You get a crash in terms of the marks. And so I think that's probably factoring into them. Okay, we're okay on liquidity, reverse repo, TGA, as long as nothing happens on a binary way to the U.S. economy, because if anything happens in a binary way, risk-off way to the U.S. economy, or global economy for that matter, the dollar's probably going to go up. And when the dollar goes up, we know the Treasury market will come unhinged. We saw that in the third quarter of 2023. TLT, the long-term Treasury bond ETF, fell 20% in a quarter. So while everyone's been looking for where's the next crash, next crash already started. We already saw it. It was in treasuries. It was in the risk-free asset of the world. And it'll happen again if the dollar rises. So I think that's what these banks are seeing in terms of why the ISDA letter now is it's a very dangerous situation, because as many people have noted, treasuries are the collateral underpinning the whole system. So when the collateral has a problem, the whole system has a problem. And so I think they're just trying to get out in front of it, seeing this. There's liquidity there, patchworks, reverse repo, TGA. If they can keep the dollar moving down in a linear, orderly basis like they've been doing since September of 2022, you can sort of square all the circles with some hiccups like we had last fall. But I think that's what they're looking at.
Coin Stories is brought to you by Bitdeer, where the power of Bitcoin mining is at your fingertips. As a publicly traded leader, Bitdeer's global reach and scale means they're everywhere you need them to be, ensuring you're part of the thriving Bitcoin economy. Bitdeer's not just mining, they are industry pioneers, and Bitdeer stands alone as the only vertically integrated, technology-focused Bitcoin mining company. What does that mean? Well, they're not just deploying, but developing the latest tech to make Bitcoin mining more efficient and effective. With the industry's most experienced leadership team, innovation is in their DNA, and it shows, with a quarter of their workforce dedicated to research and development, pushing the boundaries of what's possible in Bitcoin mining. Now they're leveraging years of expertise in data center and cloud management into high-performance computing through a recently announced partnership with NVIDIA. Join Bitdeer in reshaping the world of Bitcoin mining. Learn more at bitdeer.com and explore how they are pioneering the future today. I want to talk to you a little bit about Janet Yellen, because I saw clips of an interview she did with Fox, and she said that she regrets saying inflation was transitory. You've talked about in your work her strategic moves to weaken the dollar so that everything remains functioning. Can you talk a little bit more about the strategy and how they've been able to kind of keep things afloat with so much weakness under the surface? Because for a time, I thought that people, including Janet Yellen, who are leading us economically, I thought they're pretty incompetent. But when I read your work, I'm like, oh no, they know exactly what they're doing. And they really are holding things together as best as they can. Like, they're very smart about it.
Yeah, I think some of them are, for sure. And mea culpa, I thought Yellen, I did not think all that much of Yellen if you would have asked me 3 years ago, 2 years ago. And over the last 12 to 18 months, when facts change, I change my mind. I have to give credit where credit is due. She has repeatedly shown an understanding of and a realpolitik ability to address those issues relatively in real time. So she knows where the levers are. We saw that starting, I think, in fall of 2022, when we saw her, Powell was saying, hey, we're higher for longer, more QT. And she's like, no. And she ran down the TGA to more than
Wow.
offset what Powell was doing.
Mm-hmm.
And it's been sort of that ever since. There is, even last fall, again, we had the Treasury market crash 20% in a quarter. And she surprised everybody by significantly shifting issuance from the long end into the short end to basically take advantage of reverse repo, which it was just functionally nothing more than QE that would have been previously done and sterilized. So you can see these types of moves where she really understands the levers in the game that she has to drive the process and to sort of keep the wheels on the cart. And so once you start to see that repeatedly, right? Anybody could have gotten lucky. Hey, emergency, let's do. But she keeps doing the right thing to keep the wheels on the cart. There are trade-offs to this, to be certain. But to keep the wheels on the cart, she keeps doing the right things. After she does it enough times in a row, you can see, right? It's not luck. She's
Wow.
watching the gauges on the screen, at least some of them that I'm watching on the screen. And she's reacting to them in the same way that I would be reacting to them if I was sitting in her seat trying to prevent a calamity. And once we see that, that's very powerful information, because now we can say, okay, what do we need to keep the wheels on the cart from here on out? Okay, we can't have a strong dollar. Strong dollar, number one, is like Katie bar the door, game over. You're going to go right back to 3Q23. So that's going to be, I think, avoided. We know she's got the reverse repo she can draw down mostly. She's got TGA in her back pocket that she can address. And as long as she keeps the dollar moving down in an orderly basis, and oh, by the way, her people are over in Beijing meeting with the Chinese. Biden, her president, her boss has met with Xi in San Francisco. I think to talk about a deal to weaken the dollar on an orderly basis over the ensuing quarters and years relative to the yuan. And if you kind of look at all that, you go, okay, that's not to say we can't get counter moves in all of this, but if she understands the levers and she has a demonstrated her understanding of the levers she needs to pull to keep the wheels on the cart, she's going to keep the wheels on the cart. She's the Treasury's, Secretary of the Treasury. She can pretty much do whatever she wants, just with approval of the president, and he's going to give her his approval. So there's an election to win. So
Yeah.
that's how I've been looking at it over the last. Like I said, it really started in the fall of 2022 with the U.S. dollar at 113. Right, U.S. dollar's down to 103. So we've gone from 113, 114 down to 102, 103 over a 16-month period of time. It's a pretty big weakening so far in a very orderly basis with a couple counter moves that got pretty sloppy pretty fast.
Am I wrong though to have seen that the dollar is sort of strengthening over the last couple of weeks, and also the price of oil is going up? So is something kind of turning that they will have to step in and maybe do the reverse repo drawdown again, or what's happening right now with the dollar?
Yeah, it's clearly bounced in the. I don't know, bounced is strong, but it's definitely it hit whatever 102 and 102.40 or something a couple weeks ago. It's back to 103 or whatever, so it is definitely up off the lows. I've not looked at it technically relative to like the 50-day or anything, a moving average or anything like that, to kind of see if there's anything, because if you break through the 50-day on the upside, a lot of the shorter term traders are gonna may sort of take a counter cyclical trade with it, which again, that is going to create problems for the Treasury market. That is, there is no question about that. To your point, weaker dollar, stronger oil, that too is going to create problems for the Treasury market once oil, I think the number is $85, maybe it's $82, but once it kind of gets above that threshold, you start to get into a price range where historically foreign foreign creditors of the US that are also oil importers, so
Mm.
Japan, China, South Korea, much of Europe, get pushed into a current account deficit position domestically, which means they have to basically sell treasuries to buy oil. And we've
Right.
seen this repeatedly. If you call up a chart of the 10-year treasury yield against oil, against the yen dollar cross rate, it's like perfect post COVID, 1 to 1. As the yen weakens against the dollar, the 10-year yield goes up.
Wow.
So that's been the relationship historically, and those things are coming to a head. The question then is what did Biden and Xi talk about in San Francisco? Because I think there's a real shot that part of a deal would be greater ability to buy oil in non-dollars, and that starts to change the game in terms of that relationship of higher oil necessarily being strictly bad for the Treasury market.
Right. Okay. You talk about that a lot. I want to return to China in a moment. But first, I do want to ask you about the Bank of Japan, because I read that they're thinking about raising interest rates for the first time in like 17 years. And that really would put pressure on the dollar, right? Because they might have to sell a lot of their treasuries. And they've been a buyer of treasuries more so than other nations, right? Can you kind of update us on that situation?
Yeah, I think whatever the Bank of Japan decides is critically important for any investor in basically any asset class in the world to pay attention to, because of that linkage to the dollar, right? The DXY index is basically the dollar against the euro and the dollar against the yen. And if the Bank of Japan starts raising rates, it is likely to strengthen the yen pretty meaningfully, weaken the dollar. And I think ultimately that then leads to two counter forces in US asset markets. So it should, all else equal, you would think via the repatriation, right? They're selling dollar assets, bringing yen to buy yen, selling dollar assets to raise dollars, sell dollars, buy yen assets. All else equal, there's a couple different dynamics. That all else equal, that should be negative for dollar assets, positive for Japanese assets. And we've seen the Japanese stock market finally break out to 40-year highs again after 30-year highs after 35 years, whatever it is. However, everything isn't all else isn't equal. A weaker dollar that would also occur from that, all else equal, is really bullish every asset given the amount of dollar denominated debt in the system. So basically, the whole world's short dollars via their dollar denominated debt. And if the dollar goes down, their ability to service that debt, their balance sheet capacity to service that debt increases. So they have more ability to buy treasuries. They have more economic growth. Growth tends to run counter-cyclical to the dollar for that reason. So global GDP growth is going to accelerate. The ability to service debt, balance sheet capacity across the world will go up if the dollar goes down. And so I actually think on a net basis, I think that is more than enough to overcome just the flows perspective of weaker selling dollar assets to raise dollars to buy yen. I think, yes, that's a negative to U.S. asset demand, but the weaker dollar impact of dollar asset price appreciation, global GDP implications accelerating, more balance sheet capacity as the dollar falls, I think that will offset. And so you'll actually, I think, get what you're starting to see, which is Japanese stocks up and American stocks up. But I think within that, you'll see sort of a vicious sector rotation, which is when global GDP growth grows, you don't need to pay 35 times sales for the Mag 7. You can pick up industrial stocks and cyclicals and commodities for way, way cheaper. And in recent weeks, you've seen a little bit of a sector shift in that way. But I think that's what would possibly occur. So there's a lot of levers to watch within sort of that yen dollar cross Bank of Japan move. But that Bank of Japan move is really, really big.
Looking at the whole international picture, it does seem like liquidity remains high despite a lot of decelerating economies. I've heard some analysts say that they predict a melt up in assets like stocks and Bitcoin. What do you think are the chances of that?
I think they're actually pretty good. It's a matter of national security for the United States to get the dollar down. It's a matter of national security for China to get the dollar down. It's a matter of national security for Japanese to get everybody needs the dollar down. And you're seeing sort of, if you take a step back and say, okay, the Bank of Japan is talking about doing this, China's doing this, the US is doing this, you start to see what looks like coordination, a coordinated attempt to weaken the dollar. It can't be disorderly. You don't want a dollar crash, to be clear. But look what we have since September 2022, when the Treasury market was, in really bad shape, and Treasury starts to weaken the dollar. Yellen goes to Washington, meets with all of our creditors. Bloomberg says the number one topic was the strong dollar. And then it was sort of officially denied. No, we didn't talk about the dollar. Whatever. But then I watch how markets trade in October 2022, November 2022. They traded like something very important was agreed to. And you can see it in charts, stocks and bonds and the dollar and gold, a whole bunch of different asset classes. Something was agreed to, I think. Who cares what I think? The dollar was 114. Now it's 102, 103. And we can see in markets what that has led to. Like, the wheels have stayed on the cart. China hasn't collapsed. Japan's stock market's back to all-time highs after 35 years. U.S. stocks are at the highs. Bitcoin's at the highs. Gold's at the highs. Bond yields are, while high in the U.S., constrained and at levels that are at least keeping the wheels on the cart. And so I think it's more likely than not that the dollar will continue to be weakened in an orderly fashion. I think it's quite possible we have agreed with the Chinese to a dollar weakening against the yuan over the next X years. Who knows? And I think Wall Street is not, Wall Street consensus at least, is not positioned for this. If I'm right, they're going to spend the next 8 months chasing this. And so 6 trillion sitting in money markets, making 5%, is going to realize it's the sucker at the card table. Oh God, I can't go back to my fund hold, my investors, and say, hey, I made you 5% risk-free this year if the S&P's up 30.
Right.
I'm going to get fired. I'm going to lose my assets. Same thing with money in long-term bonds. That's where it gets trickier, right? Because if the long-term bond yields rise as money flows out of them into stock, to be clear, Yellen has done a magnificent job, but her operating window just keeps getting smaller and smaller, as do all these policymakers. The holy grail to buy them time is continue weakening the dollar. And I think it's in all of their interest, right? They're in a situation where if they don't hang together, they're going to hang separately.
Well, I know we do a great job kicking the can down the road, but how long can they actually keep doing this? Because at some point, don't you need to just, finally face the consequences of all of this manipulation?
It depends. Yes, but you get to choose your consequences.
Okay.
Look, if they want to stop the inflation, they can do so. All they have to do is cut rates to zero, the Fed. Then they need to slash the federal budget and basically balance the federal budget one way or another. And the problem, of course, is the Fed has no control over the federal budget, number one. Number two, even if Congress could do that, and they can't politically and economically, which for a reason we'll discuss here in a second, that would require, right now we're running a 7% of GDP fiscal deficit with this strong economy. So you would, to balance the budget, and forget balance the budget, let's say we'll just take it back to a 2% fiscal deficit to kind of get us back to like near the worst of the 80-82 recession under Volcker when he successfully fought inflation. So we need to cut 7% minus 2%, 5 points of GDP out of the deficit immediately and permanently. A 5% of GDP annual decline will be worse than the Great Financial Crisis,
right,
which blew up everything. It literally, but this time, nobody gets a bailout. 5% GDP decline, unemployment goes up, no banks get saved. No bank deposits get saved. Everything over $250,000 you have in a bank, poof, gone. And then just let it keep rolling. That is choice. And oh, by the way, let's look at the makeup of the 5%. The only things big enough to cut are interest, which we just said we would cut to zero. Okay, we could that can help. But then we'd also probably have to cut, and that if they don't do the fiscal side, is going to send inflation skyrocketing. But if the other things they really have to cut is entitlements and defense, right? So let's assume we don't cut interest. They cut entitlements and defense. 5% of GDP is $1.35 trillion. So you need to take $1.35 trillion out of entitlements and defense, which is a $4 trillion line item annually. So $1.35 trillion over $4 trillion is about 35%. So you would have to cut entitlements and defense tomorrow and forever by 35%. And when you did that, the deficit in a year is actually going to be higher as a percentage of GDP rather than lower, because you've got these other counter-cyclical things that kick in and what have you. There's actually deleverage because you have, leverage cuts both ways. You've got all this debt. So your receipts are going to plummet. Your deficit's actually going to be way higher. So that is choice A. It's not going to happen, but that's choice A. Choice B is what we're doing, which is press the money market machine, the modern monetary machine into full throttle, break the handle off, and sit back. And you weaken the dollar, there's going to be a problem at some point, but
yeah,
we saw this in 2021, 2020, 2021, 2022. You tell me the level of the dollar, I'll tell you the level of the deficit, right? So if we get the dollar down and we create an everything bubble, we saw the deficit in 2020, it went to $3.2 trillion annually, biggest deficit ever, nominally. By 2022, it was 1.1 trillion. They had cut the deficit by almost 2/3. How did they do that? Well, simple. They knocked the dollar down. They created an everything bubble, and tax receipts exploded because everybody's assets went to the moon.
Right.
Great. So if you get the dollar down and assets go to the moon, the amount of treasury issuance will fall, which then ties back into this point before of if we weaken the dollar, that ironically or paradoxically supports the treasury market by significantly reducing issuance while increasing balance sheet capacity amongst our creditors. So if we knock the dollar down on a linear basis, they can kind of keep this going. The release valve then is inflation. Mm-hmm. And once inflation gets too high politically, that is your release valve, or that's your break on this whole thing. And the problem is your ability to address that has diminished meaningfully with running down the strategic petroleum reserve. Because you can tell people if inflation's 10, you can tell everyone in this country it's 3. And right. 50% of the people are going to believe it because they're Biden supporters, and 50% of people are not going to believe it because they're Trump supporters. And who cares? The thing you have to control, in my opinion, is gasoline, is oil prices. Because if you're saying inflation's 3 and gasoline is $5.50 at every corner in America,
right,
you have a messaging problem. You have a propaganda problem.
Right.
But if you can keep gasoline $3.50 to $4 and inflation's 10 to 12, and you tell people it's 3, mm-hmm. they'll believe it because we've seen them believing basically whatever they're told.
It's time for a quick break to hear these messages from my partners who make this podcast possible. First up, Bitcoin 2024. The world's largest Bitcoin conference is coming to Nashville this July. Join us for 3 amazing days of keynotes, panels, networking events, workshops, concerts, and my 3rd annual Women of Bitcoin brunch. The Bitcoin conference is actually where I launched my podcast almost 3 years ago. You never know what can happen or who you can meet here. Head to b.tc/conference and use the code HODL, HODL, for 10% off. Next up, Coinkite. Coinkite makes everything you need to safely self-custody your Bitcoin, including the Coldcard Wallet, the cold storage device I use for safekeeping my Bitcoin. You can verify the source code, it's ultra secure, and it's easy to use even if you're a beginner. Head to their site in my show notes and get a 5% discount with promo code CoinStories. Next up, CrowdHealth. Health insurance costs are sky high, and it's money that feels wasted if you don't need a doctor. That's why CrowdHealth offers a community-based alternative by crowdfunding healthcare with other Bitcoiners. I get to avoid traditional insurance fees and support real people, not mega corporations. Visit joincrowdhealth.com/Natalie and join us. And finally, the why of Bitcoin is easy to grasp, but the how can be so confusing. The Bitcoin Way is your professional Bitcoin IT and security team that offers personalized one-on-one support to guide you through cold storage, setting up a node, inheritance planning, privacy best practices, and more. Don't take my word for it. Take 82-year-old customer Bill's.
Give the Bitcoin Way a try. You will be well on your way to owning and protecting the greatest money ever discovered.
Set up your free 30-minute consultation with the Bitcoin Way today. All right, back to the show. Right. This is so fascinating. I mean, it's clear that they always pick what's going to keep things together in the short term at the expense of all the long-term consequences and economic pain. I mean, because option A, yes, it would be very painful in the short term, but arguably would cleanse so that we could kind of restart. But to your earlier point, you said that they should have let inflation run hot, get, 10% maybe beyond so that we reduce the debt burden. But what does that look like? Because to your point, they're saying that inflation has come down to 3%. And meanwhile, on a daily basis, I see these heartbreaking videos of how the average person can't afford the cost of living today because rents have gone up so much, groceries are still up. It's like how can you believe that it is 3% when most people's prices have gone up 20, sometimes 25% since the pandemic? So what would 10% inflation? How would people survive if the CPI was 10%? Wouldn't real inflation be like 30, 40?
Possibly. Yeah, and this is.
You'd need UBI.
You'd need some sort of UBI. You'd need, and this is when you do things for 2-year election cycles. And again, people do what they get paid to do. Politicians, all they got to do is get reelected. And in 5 to 10 years, they're going to be like F you rich. So they are paid to manage to 2-year election cycles. And that's fine in the short run. But the problem is in the long run, the devil tends to take the hindmost. And we are now firmly into the long run. And so what can you do? There's not a lot. There's not a lot to do. I mean, you need that inflation. Now, they sort of had a window to inflate the debt back down, and they made some progress. It went from 130 down to 120. Well, guess what? As soon as they started hiking rates, debt to GDP bottomed. It's on its way up for 3 straight quarters now. It's in the wrong direction again. It's gone from 120 to 122 over the last 3 quarters as a percent of GDP. So here we are again. Now they, because they didn't have the political fortitude to be leaders, communicate effectively with the American public and say, listen, yes, inflation is going to be 8 to 10. And here's why, because we basically just fought a war against the pandemic. And here's how we got out of it after World War II. And we're going to go through a period of 3 years where real rates are negative 10 to 15%. And your purchasing power is going to erode, but this is the price we actually have to pay as a country because we just won this war against a pandemic. And people might have, at least half the people, depending on who was saying it, might have agreed. Now, number one, after World War II, we had capital controls, so there wasn't a thing you could do anyway. Number two, we had real leaders that could communicate with people that we don't have anymore. Anywhere in Washington, as far as I can see, in terms of the senior political leadership of this country on either side of the aisle. Number three, you would literally touch off a bond market crash by saying that. And so on some level, you didn't have the ability to do that economically, even if you had the political fortitude and leadership to do that, which you don't have either. So the bottom line, though, is because they didn't do that, we don't need 8 to 10. We don't need negative 10 to 15% rates anymore. Now we're going to need negative 15 to 20. And if they still don't have the fortitude on the other side of this, then they're going to need negative 20 to 25, or else we go into a debt spiral. And at some point, the numbers just get so big, it doesn't matter. And again, they can keep kicking it where it breaks is the connections with the real world. And the most important connection with the real world is energy, it's oil.
Right.
And and gasoline in particular for the American public. So that's where it all starts to, I think, come up. That's if you're going to focus on something that is a touch point, that is a real touch point.
Well, everyone is so politically charged right now. We're in an election year. One thing I've loved about Bitcoin is that it is apolitical in the sense that it's striving to remove so much of the connection and power of money with the state and decouple that marriage. But I've sort of in my last couple of election cycles, I've started to feel so disillusioned that no matter who gets into office, it's just going to get worse for the average person. And I think a lot of people feel that way. Do you have thoughts on whether Biden stays in office or perhaps we flip red, maybe Trump gets back into office? Which one would be better or worse for inflation, the price of oil, all these economic factors we've been discussing? Or do you think it's pretty much the same?
I don't think it matters. And I don't think it matters because Trump started the country on an industrial policy, down an industrial policy path where the government comes in and spends money and directs investment as a way of basically reshoring, reindustrializing the U.S. defense industrial base that had been critically weakened and hollowed out by the last 30 years, the preceding 30 years of U.S. trade policy, 25 years of U.S. trade policy, particularly vis-a-vis China. That Trump, I think, will actually go down as at least favorable for that, for opening a conversation about, is this really in our interest? Is free trade as set up, neoliberal free trade, really good for America? And when he came into office, it was blasphemy. By the time he went out of office, Congress was begging to reshore stuff because they couldn't get masks and COVID. So that in and of itself, I think, was a huge sea change in terms of forcing the Overton window to change, right? Shifting the Overton window to change around neoliberal free trade that for 30, 35 years, offshore factories, learn to code, working class we don't need, all we need is the dollar. And that changed. He changed the conversation. He started us on a path of industrial policy. Interestingly, if you look at what Biden is doing and you look at what Biden's lieutenants are saying and began saying a year or two ago, they're doing the same thing.
Same playbook. Yeah, I've heard you say
they're
that.
running industrial policy, which is the right thing to do. They're saying it more nicely. They're not sort of, you've got a guy who's a buffoon about it, or you've got a guy who can't remember what he's saying about it, right? So it depends on who's, the difference will be who tells us about this, the buffoon or the senile old man. But the policy, I think, is going to be the same in terms of the economics of industrial policy, which is the right thing to do, and it's inflationary. The Fed's going to have to help finance it at some point via QE in some way, shape, or form, whether that's through the reclassification that that ISDA is looking for the banks with treasuries, whether it's outright QE, whether it's whatever they call it, BTFP, whether they call it, there's a lot of ways to do it, but industrial policy requires a sustained weakness of the dollar that I think will be driven effectively by the Fed and its proxies, deficit financing the reshoring of the American defense industrial base.
Is that why, in addition to allocating to Bitcoin and gold, you've been recommending sort of like industrial or energy infrastructure equities?
Yes.
And do you have advice for people out there who are looking at that sector, wondering how to invest? Do you have any recommendations?
There are some various ETFs for electrical infrastructure, industrial infrastructure that you can look up. One I've noticed recently is PAVE, PAVE. It's an ETF. I don't remember who the issuer is. I have no affiliation or no kickback or anything like that. I just look at the chart. I know the stocks that are in it, and those are the types of names that I think stand to benefit on a secular basis over the coming 5 to 10 years if we keep running this industrial policy and reshoring that it appears we're going to, regardless of who wins.
Interesting. Well, yeah, I mean, the biggest voting block is, I think, the generation that has the majority of the wealth. I think you brought up in an interview that the richest generation has $3.1 trillion right now they're getting in entitlements. And it's not politically appetizing to say, hey, let's cut those. Do you have any points you want to make on that? Because it is really sad to see these younger generations. No one can afford a house. Everyone's really struggling, even to pay basic things like rent and groceries. And meanwhile, you have some people in a very wealthy generation who don't need the free money that they're being sent by the government, but there's no one saying, no, don't send it to me.
No, they should probably means test Social Security yesterday, but even that is very politically fraught. Biden has made some comments about the tax increases he would like to pass. That billionaires pay a lot more than they currently pay in terms of a rate, and he classifies billionaires, I think, as everybody worth over $100 million. I'm not going to get into the politics of that. Yeah. Something along those lines probably needs to occur one way or another. With that said, regardless of whether the politicians have the ability to do something like that or not, Mother Nature doesn't care, right? So you've got people that are, the youngest boomer is 60 this year. The oldest boomer is 78 this year. And the silent generation is a smaller portion of it, but the boomers and silent generation have 75 trillion plus in wealth.
Yep.
And, they say there's two sure things in life, right? Taxes and death, right? So we just talked about taxes. They're trying to figure out the tax thing, but the one thing I know is sooner or later, they're all going to die.
Yeah.
And so $100 trillion is going to go to their kids, presumably. Now, there's how is the breakdown of that? It's probably, I'm sure, very top end loaded, as everything is in this country. So, but the point is that the kids are going to get it soon enough. Gen X and Gen Z and the millennials, they're going to get that wealth soon enough. And then it gets really interesting for the Fed, because it amounts to a lottery ticket for a generation that will be entering their peak spending years. Right. So what happens when you start sprinkling 75 trillion in lottery winnings on a bunch of 35 to 50-year-olds who are they're just generationally spending the most they're ever going to spend?
Well, they've been pent up. They want to spend, but they can't yet.
They can't. And so now you're going to get that's where things get really interesting, because now you'd be talking about that. And by the way, this is how you can delever and fix the economy. Right. As this happens, GDP is probably going to friggin' go to 10 nominally. And home prices are going to, if you don't like home prices now, wait till that starts happening.
Perfect.
And what's the Fed going to do? Raise rates to 10? They can't. 10 bankrupts the U.S. government. So they've got, one way or another, real rates are going to get really, really negative.
Wow. Okay.
Before we
start to wrap up, I do want to ask you about China, because China perplexes me. You mentioned earlier that meeting between Xi and Biden. On the one hand, I hear that economically they have so many issues and they're on the brink of the kind of crisis that we had in 0809. But on the other side, I mean, it seems like they have so much strength in terms of global geopolitical power. They're de-dollarizing, they're making, deals in other currencies. Can you kind of break that down? What does the average person need to understand and know?
I think all of the above is true on some level. I think the average person should probably believe about half of what they hear on China. Yes, China has commercial real estate problems. Yes, the municipalities in China have financing problems. Yes, if China has a $37 trillion balance sheet compared to Lehman, which had an $800 billion balance sheet. If China collapses, don't kid yourself. The world's going to collapse. Right. The U.S. banking system, the Western banking, everything will collapse. So, in my opinion, a good chunk of the fear-mongering that we get out of officialdom these days on China is in no small part powered by a recognition of, oh crap, we thought we were winning and we had all of the, we controlled all of the levers of power. And in a lot of ways, we're losing. A lot of the things I hear out of Washington officialdom about China now, I heard out of my late Teamster Union father-in-law and his friends in 2003, 2004, 2005.
Yeah.
So like they're catching, Washington and officialdom is sort of catching up to this now. Look, find me a country that Washington is not afraid of and is not threatened by and is not in any competition with, and try to find them talking about that nation the way they talk about China. It doesn't happen, right? It's like the old meme with Mad Men, right? Where I don't think about you at all, right? Like the fact that Washington is talking about these things is a projection of exactly how threatened Washington feels. And it's like I've seen all of the language around it before because I heard it from my father-in-law 20 years ago.
Yeah.
About China. And it was he was using the same rhetoric as Washington is today for the exact same reason. The Chinese were taking all the jobs. They were bankrupting his union pension. Like all of the economic pressures that China is putting on Washington now, they were putting on working class Americans 20 years ago. When Washington, again, it goes back to that earlier point of this neoliberal free trade, right? Yay. It was naivete on Washington's part. Well, once they become rich, they'll become more liberal. Come on, grow up. Like, what's your, like, it was just a very naive worldview on their part. And now it's coming back to bite them. And so, yes, China has problems. Are there problems as bad as I hear from Washington? I don't think so, no. I think part of it is Washington is threatened by China as on a lot of fronts you can see, China on EVs, China on, there was a great testimony by Josh Wolf in front of Congress last August, talking about that China can build a nuclear power plant for $2 billion per gigawatt. The same gigawatt costs America $12 billion to build. And so China, you can see, is going around the world and say, hey, we'll build your nuke for you. Mm-hmm. And America's saying, well, we'll moralize to you about like what flag you should fly on your capital and this and that. And China's like, hey, you've got 2 million people that don't have access to clean water. Yep. We'll give them clean water. Like, it's not even a contest. Right. Nobody gives a crap about what flag you're flying if you don't have clean water. It's an order of operations. So Maslow's hierarchy. And more importantly, China can do it for 1/6 the cost. And as a Bitcoiner, a gigawatt's a gigawatt.
Right.
Right? A gigawatt of electricity is the same gigawatt anywhere in the world, which then leads you a really interesting point, which is the dollar is 86% overvalued, right? If a gigawatt costs $2 billion for China to build and $12 billion for America to build, it's the same gigawatt. What that tells you is the dollar to drive the same, and then geopolitically, China can make friends with all of these places that need clean water and cheap power.
Right.
And then lock them in as a client state, and then they'll vote with China. And again, this is all of a sudden why Washington is like, oh God, China. They're realizing China's outplayed them strategically, because this is the same conversation, my union father-in-law and his friends were having. Great. I understand it's cheaper, but what happens when they're making everything? Well, Here we are 25 years later, and Washington doesn't like the answer all of a sudden because it's has geopolitical impacts. And it was always going to have geopolitical impacts. It's just now the geopolitical impacts are so acute that they're going to hit in the next 2-year cycle. They're hitting in 2-year cycles. So Washington has to care. Washington only cares about stuff if it's a 2-year election cycle issue. China's a 2-year election cycle issue for this reason.
So fascinating. And we are trying to reshore, but to your point, everything is so much more expensive here. And people are graduating from college expecting, $150,000 a year jobs. And there's nothing like that. And other countries can obviously produce and they're willing and able to pay far, far less. So how are we able to compete with that on the long run?
Okay. You got to weaken the dollar, right? I mean, at the end of the day, it's a dollar issue. All it is you weaken the dollar enough and we'll compete.
All right. Well, you brought up Bitcoin. That's where I want to end this. Tell me about your outlook. We just hit an all-time high recently. Obviously, drawing back, washing out some leverage positions. What's your outlook over the next maybe 6 months and 12 months?
I'm super bullish Bitcoin for the next 6 to 12 months, at least, tactically and strategically, because whether the Fed hikes or whether the Fed cuts doesn't matter. In my opinion, inflation and fiscal deficits are going higher. And the only way that doesn't happen is if the dollar is weakened. Then fiscal deficits actually will trend lower. So if my choices are higher rates, more inflation, lower rates, more inflation, or deficits down with a weaker dollar, more inflation, more debasement. I think it sets up really, really well for Bitcoin. And critically, the fundamentals are there. But then when you look at positioning, there's still a lot of skepticism around Bitcoin, and there's still 6 trillion plus sitting in money market funds. There's still a lot of concern. There's still a lot of belief that the Fed's, inflation's up, picking back up. The Fed's going to come in and smack inflation back down. No. They can try, great. And you could get a pullback on, hey, the Fed's going to go, oh my God, if we go from Fed's going to cut twice this year to Fed's going to hike twice this year, you'll probably get a sell-off in Bitcoin and industrial stocks, maybe even gold. Everything will go up with the dollar.
Yeah.
For like a week or two. Mm-hmm. And then there's going to be this recognition of like, oh God, okay, the Treasury market's dysfunctioning. We can't have that. So then that's going to start the discussion. And ultimately, 6% rates are going to be more inflationary on a lag than 5.25%, because there's $35 trillion in debt, and it's rising as a percent of GDP now, and Fed rate hikes will make it rise faster as a percent of GDP. So I'm super bullish Bitcoin because I've got fundamentals. They hike, it's inflationary. They don't hike, it's inflationary. They cut, it's inflationary. And if they want to keep the wheels on the cart, they got to weaken the dollar or continue to weaken the dollar. All of which is good for Bitcoin. And consensus doesn't realize that yet, in my view. Consensus needs to go from they're still going to get the side of the tight in the boat to where I am, which is, doesn't matter. My choices are inflate, and reinflate.
It's interesting that you say consensus, because obviously in the Bitcoin community, there's consensus that we're going to the moon, but we have to think about the consensus in the sort of traditional world. And you're right, it hasn't caught up yet. Although I do worry about the sentiment within the Bitcoin community, because it's like everyone's so certain. Last time they were certain it was going to 100. And, I think that we might hit something, but to your point, if we do, they're just going to step in and print. So I guess it's to the moon either way.
Yeah, I mean, to me, it's really important, I think, for the average investor to stay unlevered, mm-hmm. because we are in a situation nobody alive has ever seen. So you've got a bursting global sovereign debt bubble. You're in peak cheap energy. You're in rising global geopolitical competition with a near peer or peer competitor who supplies our military in a substantial way, which is
right.
And with our debt to GDP where it is, our deficits to GDP where they are, with all the wealth at the sort of the high end and amongst the oldest generation, not the youngest generation, just so many things that have never happened before. And leverage cuts both ways. So you're going to get severe pullbacks from time to time, and as we saw last fall. But ultimately, it's really powerful to know, as sort of your first principle fallback, do I think the U.S. government is going to allow a U.S. Treasury auction to fail? Do I think the U.S. government is going to slash defense? Do I think the U.S. government is going to slash entitlements? And as long as that you keep falling back to that sort of, Alamo position and saying, no, they're not going to let a Treasury auction fail. They're not going to default. They're not. Then that's why I say it's important to stay unlevered, because I think you can gauge the likely end game with a fairly high degree of confidence without worrying about what's likely to continue to be a pretty bumpy path between
right.
here and there.
Right. Short-term volatile. Wow. Okay. We've covered so much ground. Any final thoughts or anything that you wish that I asked you that you wanted to cover?
Yeah, that's you covered a lot of ground. So there's nothing that stands out to me to highlight that we may have missed.
All right. Well, I will point everyone to your work. Fantastic research. I'm going to have the links in the show notes. Luke, thank you so much for sharing your time and your knowledge with us.
Thanks for having me on. It was great being here again, Natalie.
Thank you so much for checking out this episode of Coin Stories. If you want to connect more, make sure to check out this podcast on the Fountain app. It brings creators like me closer to the global community of listeners, and it's all powered by Bitcoin. You can share the best moments of this podcast and stream stats directly to your favorite podcast hosts. And you get paid when other listeners like your clips, comments, or playlists, or just for being a regular listener. Get rewarded for helping build this incredible community. Download the Fountain app today and subscribe to Coin Stories. This show is for entertainment and educational purposes only. Nothing should constitute as official investment advice, and you should always do your own research. My inbox is open if you want to share feedback or guest suggestions. Just reach out at Natalie@talkingbitcoin.com. I'll see you next time.